All right, let's talk about K Holdings, ticker BK. They just dropped their Q2 earnings, and honestly, the numbers are sending a really conflicted message. So we're going to decode what these results are really signaling for the future of this Chinese real estate giant. The market got a classic mixed signal from this report. On one side, you have a solid beat on adjusted earnings per share. Great. But on the other, a slight miss on revenue. And that conflict, it sent the stock on a pretty wild ride, which tells you just how uncertain investors are right now. So first up, let's just look at those headline numbers that really got everyone talking. Okay, the good news first. On the bottom line, adjusted earnings came in at 1.55 RMB per share. That just barely squeaked by Wall Street estimates, but hey, a beat is a beat. And it shows they've got some good cost discipline going on. But see, this is where the story gets a little tricky. The top line, well, that tells a different story. Revenue hit 26 billion RMB. And yeah, that's up over 11% from last year, which is solid growth. But it missed the target. And that's what's raising questions about their momentum. And here's the story behind those numbers, which is actually fascinating. For the first time ever, their non-housing services, we're talking things like rentals and renovations, accounted for a record 41% of total revenue. So the company's big strategy to diversify, it is clearly working and finding new avenues for growth. But, and this is a big but, that diversification and growth comes at a cost. And that brings us to the biggest challenge this quarter, and frankly, the main reason for all that investor caution, a significant margin squeeze. Just look at this. Look at the pressure on profitability here. Gross margins fell a staggering 600 basis points year over year. They dropped all the way down to 21.9%. That's a major haircut, and you can bet the market definitely noticed. So, why the collapse in margins? Well, it really comes down to three things. First, that successful diversification, it's a bit of a double-edged sword, right? The new growth is coming from businesses with lower margins. Second, costs are up because the company is investing more in agent welfare. And third, their main cash cow, the existing home business, is underperforming. So, the big question is, how does management plan to fix this margin problem? Well, they're not just sitting around waiting for the storm to pass. They are pivoting the entire company's growth engine toward a brand new source of power, artificial intelligence. Yeah, CEO Stanley Pong made it crystal clear on the earnings call. The era of just growing by getting bigger, that's over. The new strategy is all about efficiency-driven development, and AI is at the absolute core of this plan. They really see it as the key to unlocking the next big wave of productivity. And they're rolling this out across the whole business in three key ways. First, they're giving agents AI tools to make them more productive and, close more deals. Second, they're using AI internally to make their own operations, everything from new home projects to rentals, way more efficient. And third, they're actually creating new AI-powered tools directly for consumers to make searching and buying a home a better experience. And hey, this isn't just some theory they're talking about. It's already working. Agents using their main AI tool are already seeing a massive 30% jump in their conversion rates. That is a real, tangible productivity gain hitting the front lines right now. Okay, let's zoom out a bit to the broader market context. Let's look at the major forces, both the good and the bad, that investors really need to be watching. The macro environment in China's property sector, well, it remains a pretty significant headwind. The central bank left key lending rates unchanged, which means no immediate relief for people with mortgages. Property prices are still soft, and new home sales across the country were down over 5% in the first half of the year. It all points to the same thing. Weak consumer demand just isn't going away. However, in the face of all these headwinds, management sent a really powerful signal of confidence. They announced they're expanding their share repurchase program to a massive $5 billion, and they're extending it all the way out through August 2028. That provides a very strong capital return backstop for shareholders. It's a big deal. So let's put it all together. What's the call on BEKE moving forward from here? Is this a story of a successful, if a little painful, transformation into a diversified, AI-powered platform? Or are the cracks in the foundation of its core, high-margin business just starting to show? The bull case is compelling, right? The diversification strategy is clearly driving growth. The big pivot to AI could totally transform their efficiency, and that $5 billion buyback provides a really strong floor for the stock. But the bear case is just as strong. that margin compression is severe, the macro environment is weak, and their core business, the real cash cow, is contracting. So for now, our rating is market perform. Look, the company is making the right long-term moves with its pivot to AI, but in the short term, that severe margin pressure and the weak macro environment are just too significant to ignore. The key question for next quarter, and the real test for this whole strategy, will be this. Can their AI-driven efficiency gains start to outrun that margin decline? We'll be watching. And as always, just a reminder, this content is for informational purposes only and is not financial advice.